Hey everybody, this is Noel at HomeQwik, and I want to introduce you to a couple of my real estate friends and associates here in the Valley of the Sun. We've got Nick Ptak Residential Realtor and James Igbinovia with VIP Mortgage, our loan extraordinaire. Guys, why don't you introduce yourself, give us your website and your contact info. James, go ahead.
Hi, I'm James Igbinovia, VIP Mortgage. I've been in the business now for about 16 years. My website is jamesi.vipmtginc.com.
And Nick.
How's it going, everybody? Nick Ptak. I'm a realtor here in Phoenix, been in the business 5 years. My website is www.nickptak.com, and you can find anything real estate related there.
Cool. So the date for this podcast that we're doing is actually March 31st, 2021. And we want to talk about what's happening in the market today. And we'll cover a little bit of general things that are always true, but we're really focusing on what's happening in the greater Phoenix area right now in 2021. So Nick, we'll start with you today. Number one question on anybody's mind, including myself, and you know that I'm a realtor as well. And I'm actually shopping for my wife and I. Is this another bubble? Are we in a bubble right now?
It's a great question. And the short answer is, because a lot of people say, is this like 2007 to 2009? It does not appear to be. So the reasons I say that, first off, the prices are high. I definitely understand that.
Sure. 2007
to 2009, there were no lending regulations. You could make, $30,000 a year and get a $400,000, $500,000 house. You didn't have to put 20% down for an investment property. So the ability to purchase a property was not as strict as it was now. Payment now.
Everybody could get a house, right?
Yeah. It's kind of like credit card financing commercials, like in terms of automatically approved, or a car loan. If you ever listen to car loan commercials right now, they're doing the same thing.
Yeah.
So the lending regulations tightened a lot, which has made probably James and I's job a little harder, but I think it's good because our default rates are way lower. Incomes in Phoenix have gone up a lot of tech jobs, a lot of semiconductor companies moving here. There's a huge Taiwanese company moving here, Intel. You have 300% less supply than a normal balanced market. Normally there's 6 months of inventory for a balanced market. There's like less than 2 months. The demand is still there and the interest rates are still at all-time lows. You'd have to have three things flip: interest rates skyrocket, supply skyrocket. And the last thing I'll say why it's different, homeowners have equity. People, if they can't afford their payment, are going to sell normally, not in a distressed way. So do I think prices are high? Yeah, I do. I just bought my own house though a month ago. And I think there's certain value buys still if you're looking for a long-term place. I still think there's a lot with low interest rates, but it is not like 2007, 2010. If you're playing the percentages, how likely is it?
So one of the comments I have on that is I remember back in those days at managing properties, once the market started to turn, the builders, were just dumping properties to us. And even before that, tons of investors were buying. The market was flooded with rentals. So we actually had inventory on the rental side. And just like the sales side right now, there's just no inventory.
Right.
What do you think about the builder inventory right now? Or is it going to increase? Is that going to help us get any inventory that, give people with, let's say under 500,000 is going to give them an opportunity to get into this market?
Yeah, if builders can find plots of land to build, there's two general things. You either go to the outskirts of town and you build on the fringes and out where land is cheaper, or you try to find infill land and do developments. The challenge with infill developments is expensive because the lot location and the lot value is high. The other challenge right now is in building, the lumber prices are gone through the roof. So that's why the prices have gone up on new build homes. But yeah, the more new build inventory we have, the more it's going to help. And I think builders are trying to build as much as they can. You have local builders here and Fortune 500 publicly traded companies that are builders looking to buy land here and build, whether it's infill, which is a lot harder. That means in Phoenix or in Scottsdale or in Biltmore, in Tempe, or on the outskirts of town where, Casa Grande has exploded, Coolidge, Florence, Santan, Queen Creek, I think
Maricopa.
Right. Maricopa. Yeah. I mean, it's just crazy to think like, Gilbert used to be 10 years ago so far out. And now the East Valley hub has like over 1 million people, and the businesses are moving out there. So that's why it's just an interesting time how our city's growing, and it's great.
And when I first started doing this, Surprise and Buckeye were blowing up, and those seemed really far to me. And Maricopa had one subdivision.
Right.
I haven't been down there in a while, but I'm sure it looks like gremlins, and they fed them after midnight down there, right? And yeah, you're right. All of my vendors are saying, textile costs, lumber costs, everything is just going up. So I don't know. Do we need to build container homes? That's just a joke, but
right. No, yeah.
So you touched on this a little bit, but what is causing the rising prices, and what do you think the next couple of years look like?
We touched on a couple of things. It's low demand. Sorry, opposite. Low supply.
Right.
High. The demand is still there. The rates have helped affordability so much in two factors. One, on purchasing a new home, but on James's side, you can attest on refinancing. That's another reason why there is less supply in the market too, is because people went from having, let's say, a $2,000, $2,200 a month payment on a $400,000 house, maybe down to $1,700 because they've refinanced a couple times, which is great for long-term, not having people foreclose or not having to sell because they can't afford it. That's causing, also the influx from all different states, California, Washington State, Midwest. People are seeking to move to Arizona because we're business friendly, tax rate wise, things like the great weather. And now, we have a lot of companies moving here, and it's a great place to live, good restaurants, all that stuff. So but what do I think the next few years look like? Nothing lasts like this forever, meteoric prices. I think the next 45 to 60 days, this frenzy of like 20 to 30, 40, 50, $60,000 over asking, it's crazy. This is, I think, is going to stop in the next 60 days, because eventually buyers are going to say, whoa, time out. I don't want to do this anymore. This is too much. But I don't know necessarily if the price is going to go down that much unless, like I talked about earlier, a couple of those things flip. Like you'd have to have demand fall off a cliff, interest rates spike 150 basis points up to like in the mid 4s or 5, and you'd have to have prices continue to go up to where people say no in order to flip it and really even out the market. So I just think, and the hope is, if prices stay the same or go up slightly over the next few years, that it's more of just like a couple offers on every house, not 50 on a $400,000 house. Like, no one enjoys that. It's a lot. But
I think you're right that people are going to get weary of it. And you touched on, those super high interest rates of 4.5. Shoot, I remember 4.25. I thought I hit a home run. We'll get to you in a minute, James. Don't worry. So last question, Nick, so we know it's challenging to find something right now.
Yeah.
You're competing against tons of offers, a bunch of sight unseen, people with cash. If they sold in California, they're coming here with a bunch of money and beating us out, right? And beating out our clients. So is there some sleeper pocket neighborhoods that people don't consider in Phoenix that are on the rise? Is there some neighborhoods that you think are going to be coming up and might be?
Yeah. And I think that question is a great one, because it implies like what's going to hold value well, increase long-term, and probably be a safe store of value. I like a pocket east of where I graduated from high school. I graduated from Sunny Slope, which,
the Slope. I
was Slope. So, 12th Street and like Butler, south to 12th Street and Northern and east of there.
Sure.
I think is a little pocket people don't think about, because it goes from 12th Street up, into the mountains over there. And generally, if you're close to mountains, people love mountain views. That holds value.
There's some old funky stuff over there that needs remodeled and stuff.
Yep. And it's still kind of in North Central Phoenix. There's good restaurants. You're close to freeways. You're close to a lot. I really like where I grew up as a kid, the 51 and Shea area.
Yeah.
The 51 and Shea is just north, if you think on a map, Phoenix, north of North Central, and it cruises to 51. Those neighborhoods in there, there's some old Haver homes, there's some cool architectural homes. And 32 Shea, which is a development that's taken forever to develop, still hasn't fully, but like there's stuff coming up. A Press Coffee roastery, there's restaurants going in, and those are flat lots that are the older homes that, you know, some have grass, some are desert scape. I think that area is going to be in.
There's a lot of small, and those are older homes, so they have a lot smaller models and floor plans too. So there's
you can add on square footage. Yeah,
exactly.
Like you got like a quarter acre, third acre. I like that a lot. And, you know, I think too, parts of Levine, because the freeway went in,
Sure.
you know, you got those big old ranches out there. That 202 loop that now ties down, you know, around South Mountain, I think that's definitely one to look out for. I like that a lot. And if you want something on a higher end play, where like it's, you know, the homes are big, half acre, I love between 52nd Street and Cactus to Scottsdale Road and Cactus to 52nd and Shea to Scottsdale and Shea. I like those a lot long term.
Cool. Well, good. Great stuff, Nick. And we're going to jump into a couple of questions for James here. James, Nick touched on it. Rates are going to skyrocket, right? It's all going to be your fault, man. What is the current, you tell us good news. What is the current rate forecast through, let's say, through the end of the year?
So I'll say this, a lot has changed in the last, 30 to 60 days. We've seen rates just jump up, 0.5 to 0.75% depending on scenario. And then investment properties, if you've not been paying attention to the news, investment rates have just completely jumped up as well. But the forecast initially was everything would stay in the low to mid twos throughout the first half of the year. The second half of the year, things will start to change. And with the regime change from a political standpoint, they're expecting some more influx of dollars to come into the market, and also just inflation to run a little bit. So now we've seen some pressures, some upward pressure as far as rates are concerned. So right now we're sitting in the low threes for 30-year, high twos, 15-year, and I think we'll probably settle around there for the next 3, 4, 6 months. And then we'll start to really creep up, I think, into the high threes, low fours, I think, in the next year or two. So the Fed is committed to try to do all they can to keep rates low, but they're really not in charge. So
that's a common misconception.
Yeah, right. So and at the end of the day, the investors are in charge. Bonds play a big part in this. And the bond market is really still trying to digest what the administration is going to do, what this supply glut is going to do, or issue is going to do. There's a lot in play. So
to piggyback that a little bit, in my opinion, part of what helped the bubble burst the first time is politics got involved with lending. They basically wanted everybody to be able to get a house, so they let loose, cut all these restrictions like Nick was talking about. Anybody could make whatever offer they wanted and say they made as much as they wanted to make up, right? So do you see politics having anything to do with lessening some of the restrictions, possibly creating that type of issue?
Honestly, I'm not seeing that. I'm seeing the opposite. So
Okay.
To kind of
it's
back
getting
up,
tighter.
It's just back up what Nick is saying there.
Okay.
Not only as you know, Fannie and Freddie went into receivership, right? So that means that the government took over and they said, hey, you have to run this the way that we want you to run it. So with that in mind, they're being very conservative. They did allow some forbearance stuff and deferments to happen with all that COVID has brought, but even that's set to expire come June, July. So, now what's happening is the GSEs, Fannie, Freddie are starting to understand that there may be some risk coming down the line, and they're tightening up their policies. They're tightening up the automated approval systems. Yeah. So things that I would have been getting an approval on 30 days ago, I'm not getting an approval on. I mean, I just had a client with mid 700 scores, 5% down, and the system didn't like it. So it's so it's getting tighter because of they're afraid of another 08. So I think those are things that'll help mitigate the bubble talk and the bubble reactions.
Well, another side question on that: if people are, if it is tightening, what's a couple of just quick things people can do to prepare themselves to be easier to qualify? I mean, is it paying down debt? What's just a couple of quick things they can do to kind of prep before they see someone like you to help that approval process get easier?
I think the biggest things, like you said, the debt is always helpful. A lot of individuals, sometimes they're not sure really how to go about it. They just think, okay, I'm going to take this money and apply it here, or take this money and apply it there. One of the things I have stressed with all of my clients is, it's important that we take a look at where your credit sits. Let me strategize on that, or strategery my way through it. And whatever it is that I'm going to do, whatever advice I'm going to give you is going to outweigh the effect of any type of a credit inquiry. So let's get you dialed in. Let's figure out where to put your stimmy money and get you and get you in a home. But there are many tricks. That's just one of them. So
don't buy a new car, right?
Definitely, yeah. If you can hang tight on purchasing whatever you think that you need to purchase, I would highly recommend it at this time.
Okay, so I'm getting this question a lot from some of our tenants who are thinking about they're asking me this on rental as well, but also some of them are wanting to get back into the market to shop for a property. So if I'm self-employed, how is COVID impacting my ability to qualify for a mortgage?
It's a big change. A year ago this time, I didn't need nearly as much. We weren't looking at the last 3 months bank statements. We weren't getting the year-to-date P&L. Right now, with COVID, they're analyzing the P&L specifically against the tax returns. And if the P&L is lower, they'll use that calculation. So it's just, whereas before the P&L was just really for guidance, it was never really for actually calculation and saying this was your true income. If you've gotten the PPP, we can't use any of those funds. We have to do a calculation to back those funds out. There's a lot, but the good news is, I'm starting to see a lot of businesses recover. I'm starting to see a lot of my self-employed borrowers starting to show the trends of more money going in than going out, which is another thing they really pay attention to. Okay. You can put all the money in the world on a P&L, but the bank statement really tells the truth.
Well, it's about income flows, right?
Right. So if you say you make $100,000 a month, but your bank statement shows you're losing $100,000 a month,
someone's lying.
You're not getting the loan done. So, but that's part of the strategy I have to employ, right? Sometimes. I just had a client that he bought a new truck, he bought a new trailer, and he bought a new Bobcat for his personal use. So I got the invoices and I basically categorized those as owner draws, which allows him now to show a positive cash flow versus a negative cash flow. So there's a lot that goes into it.
Again, no big purchases before they talk to you. What about
real quick, including while you're under contract, I know furniture is expensive. Please don't open up a massive credit card because it's really tempting. Please talk to James.
The Memorial Day sale, the 10% off is not worth it.
President's Day sale, the this sale, the that sale, the Clayton Barrel, Bed Bath & Beyond.
Whatever it is, unless you can live in it, if we don't get the loan, you shouldn't get it.
just wait till closing day, right?
Yeah, true.
Or maybe the day after.
Okay. True.
Final VOE is done, right?
Nick, won't you save money on moving costs? Because a lot of these places will ship that furniture for you, right?
Yeah.
So do it after you close.
Yeah.
Good point. So what strategies, this is really important for me and for Nick. What strategies can we use to help our investment clients qualify for properties?
So one of the little known things as far as an investment's concerned is I have two products that are very, very cool. One is you have conventional financing, but what you can do is use proposed or future rent. So I've got a couple clients now.
Wait. You can use proposed or future rent?
That is correct.
We never used to be able to do that.
Yes. So you can use. So let's say you're buying a $500,000 home now. You think you can get $6,000 a month for it. The appraisers will get appraisal schedules, which just basically says, hey, this is what this should rent for, and we can use that future rent to help you qualify. So awesome. That's huge, right? Yeah. For those people that are trying to get into the game. I think the biggest thing is then you just have to make sure you have the down payment, and then we'll figure out the rest for you. So that's one. And then I do also have some products that are what we call DSCR products that allow us to say, hey, this is the proposed rent. The rate's a little bit higher. This is for our, people that have a hard time showing some income or credit's not where it needs to be. It's kind of more of a portfolio product, if you will. But sometimes it simplifies things, especially if the numbers from a cash flow perspective and cap rate perspective are really high. So
Where are they getting those? Where are the appraisers getting those rent numbers from? Are they calling property managers like me? Are they doing just off the MLS? What are they?
they're basically getting them off of the MLS. So they're
Just-
seeing what's rented, what is closed from a rental perspective, and then applying those rent schedules. And they're also seeing what's on the market too. So it's kind of like a typical appraisal. So they'll see what's on the market, what's closed, and give us the average of what they think the rent should be in that area.
And well, for me, that's that's really cool and good news. Well, great guys. Tons of great information here. We never want to make these too long, but you guys both hit on some awesome points. And wow, what a different market we're in. But I see positive stuff and opportunity coming, and you guys both highlighted on ways that we could take advantage of that opportunity. Any final comments, Nick?
No, I think we hit on everything, and long term, the economic forecast looks good for Phoenix. I think I keep it simple: population growth, income growth. There will be trends. Real estate's cyclical.
Always.
It goes up to stairway to heaven or stairway to hell on the back end, going down forever. Like, you got to look at the long term of thinking about Phoenix for investment properties, right, on the property manager side, on owning housing in Phoenix long term. For the long term is always a great play.
Yeah, we rent houses every month. The slowest month is December, just right before Christmas, but
Yep.
it's always good in here in Phoenix, right? James, what about you? Any final comments?
No, I think thanks so much for having us. And again, as a reminder, like these, there's some great products out there for investments. So, and we've got somebody here, I think it'll help you rent those quick. So definitely touch base with us, and let's give you that strategy you need so that we can put your investments to work for you.
All right, guys. Nick Ptak, James Igbinovia. I'm Noel Polanco. Thanks, everyone. Hope you tune into the next podcast. And again, if you need information or you got more questions, all our contact info's here.
Yes.
We'd love to help you.
Thanks, Noel, for putting this together. James, great seeing you, man.
Good seeing you guys. Take care.
Bye.